Hunter, can you put your arms down? Sorry, it's rubbing against your
Oh, sorry.
shoulders.
I'm posing. I'm flexing. I'm flexing verbally and physically on you, Harry.
Hey, ladies. I am so excited for this. Hunter, Satya, it's been 6 and 7 years. As we just discussed, Satya was first. But first, thank you both so much for joining me again today.
Thanks so much.
So happy to be here.
I think the real anniversary, Satya, is this 10 years since we started pitching the first fund? Did we start pitching this week 10
That's
years
right.
ago?
January of 2013. Yeah.
Oh my word. Well, there we go. 10 years. I mean, what an incredible milestone. But I want to start with a little bit of context. And so tell me, when was that we're going to do this? You know, there's that moment in a partnership when it's like, should we take the jump? Should we? When was that moment of, fuck it, let's take the jump and let's do this together? And either one of you can lead on this one.
Summer of 2012, Hunter and I were getting together for one of our normal breakfasts, and that's when we first started talking about doing something together. We had no idea what shape it was going to take. But I'd say the decision to work together really happened Thanksgiving of 2012 after Hunter asked his mom whether it was a good idea to work with me or not. And she signed off, and the rest is history.
Did you have any reservations when you made the decision?
By the time we got to the decision, I don't think we had any reservations. We spent so much time, even though we had had a decade of a relationship together, focused on making sure we had a shared definition of success, clarity around how we wanted to spend our time, an understanding of each other's strengths and weaknesses, that by the time we got to the decision point, it was easy. And it's been easy ever since.
Yeah, I think the only question on my mind was, you know, as Satya mentioned, we had known each other for a decade before. We always thought we were going to do something together. But at the moment at which we finally had that blank piece of paper, right? So I was leaving Google, he had left Twitter. If we hadn't come together at that time, neither one of us was thinking about venture. That was probably just the biggest gut check. Like Satya, who probably was going to start a company or, you know, sort of join another one in a product leadership role. You know, my question to him was, are you really sure, you know, you're done operating? Or is this going to always be kind of a little bit of an itch that you wish you had one more swing, you know, at being on the org chart as opposed to the cap table? And for me, it was just, I kind of thought I was done, you know, doing. I thought I was going to be helping, but I didn't know what that meant. And what I had to ask my mom was whether she thought it was better for me to take a year and just kind of polymath, right? Like write, advise, angel invest, and sort of see if that was sort of a divining rod, you know, that would show me a true north to what I wanted to do next, or if I could preempt that a little bit by joining, you know, a close friend and former colleague to do something that felt very right in the moment, but would sacrifice that sort of, you know, value of the journey.
Hunter, my mother still sends me a weather update in the morning and tells me to wear a jumper. And so have no fear. I'm heavily reliant on her as well for her advice. Can I say, we see a lot of partnerships form today. And I think, you know, bluntly, one of the biggest reasons, you know, funds don't work is because partnerships break down. For people coming together in that very early stage, are there any core questions that you would say they should align on first before engaging on the partnership? You said there about a shared definition of success. Is there anything else where you think they should align before engaging in the full partnership?
Yeah, we talked about that shared vision, but I think just as important is understanding what gives energy and saps energy for each person, so that within the context of the day-to-day, there's clarity around what role each person will play and what they're willing and unwilling to do, and the other person being comfortable with that. So I think we spent a lot of time thinking about that. And I think that's important to talk about whether you're founder starting a company or, you know, GP starting a fund, right? Because there are so many aspects of managing and building a fund that not everybody is either well suited to or excited about. I'm sure you appreciate this at this point, Harry. The other thing I think was clarity around what makes for a homebrew investment, right? And so I think it's important for GPs to have an understanding around, you know, some fundamental joint view of these are the types of things that we want to look for in companies that we support, right? Because I think a lot of arguments can happen, a lot of partnerships can break up because the types of things that they gravitate towards are so disparate or so unrelated to each other that in small partnerships, the partners can't jointly be helpful to those companies or get excited about those companies, and then it becomes finger pointing and allocation of credit and those kinds of things. And we've never had any of those kinds of issues because we don't do deal attribution. Every decision is made by consensus, and we both work with every company in some type of way. So I think that's pretty fundamental.
I have this discussion with my partner now, though, on the fund, Kieran, who does pre-seed investing for me, and I always say to him, I will never block you doing a deal. If you want to do a deal and I don't want to do it, you can do it because I don't want to lose the outliers. Were you not concerned that actually you would lose the outliers with the consensus decision-making, that you both had to love it?
So, Satya came from, or had previous larger fund experience where he had exposure to what happens in sort of voting dynamics, structure, consensus, non-consensus in a large room. And I almost certainly think that if there were 3 or more of us, consensus would be, a foolish goal, wouldn't serve us or the founders well. I think though, and this is something we, continue to or have interrogated over time, like, do we need a silver bullet? Do we need this? Do we need that? When we look at the benefit of consensus, we think it does a few things. First, it, from the get-go, unites us against an entrepreneur, against an opportunity. And it's never, the consensus is never, well, you like this and I like you, so why don't we do it? We can have different degrees of certainty, different degrees of enthusiasm, see it in slightly different ways, but we both have to be, sort of above the yes threshold. The next thing it does, I think, is it unifies and solidifies the relationship we have with the founders. It's not Satya wanted to do this deal and Hunter was skeptical. It's you're taking money from Homebrew. You're not taking money from a GP at the firm. We look back and we've struggled over 10 years to find an occasion where if there was lack of consensus, it meant we didn't do the deal. And I don't think we have any, quote unquote outliers that were, false negatives because, one of us loved it and one of us didn't. Our regrets, our false negatives tend to either be misses, we didn't see the deal at all, in a 2-phased approach where maybe one of us would look at it first and then decide to bring it forward to the other partner or not, not bringing forward something that had promise. And I guess, lost deals, which isn't a false negative, is just, something you wish you could have done. And so we've always focused on how do we get better at those? If we see more of the great opportunities, if we do a better job collaboratively figuring out whether we are the right fit for that founder and they're the right fit for us, and if once we have intent, we can approach 100% win rate as best we can, the impact of improvements across those 3 far outweigh sort of the question about, in our mind, consensus versus non-consensus.
A deal attribution, you mentioned that, and then I promised to get to the schedule, but you mentioned deal attribution. I'm totally with you. I like not having deal attribution, but LPs do love it. And I know obviously you don't have LPs now, and we're going to get to that. But how did you get around that with LPs who are like, no, we want partner attribution on deals? And that's not always possible for a lot of funds. How do you think about that?
I think first, Harry, it started with actually LP selection. When we were raising we've been institutional forever. We started with the idea, we can talk about why, but we've started with the idea that we wanted a small group of high quality investors who are committed to venture and hold us accountable to producing, not just average returns, but returns as good as the great, funds that they already had in their portfolio. The self-selecting group we ended up with at the time, this was 2013, we got introduced to a bunch of institutional LPs by our friends at, the first generation of seed funds. Chris Sacca, Josh Koppelman, Michael Deering, that type of stuff. The LPs we ended up with were all LPs who were excited about equal partnerships. The ones who passed on us were ones that wanted a single key man. Like this notion of, well, it's great to have multiple GPs, but at funds under $100 million, we really like to see one person in charge. Steve Anderson, Michael Deering, Chris Sacca, Jeff Clavier, right? And so the people who I think were really concerned about deal attribution and one person pilots the ship, that type of stuff, like they didn't invest in us. Like the people who invested in us were ones who were perfectly happy to believe that like Homebrew was going to be greater than the sum of its parts. And those parts were the 2 of us as, equal GPs and co-founders. And so I think that sort of solved for it. Now, in actuality, even though we don't do deal attribution and we don't, submit information to the Midas list or so on and so forth, like I was really proud when, again, submitting no information, just going on like, whatever publicly available chatter or so on and so forth. Like Satya got named to like whatever the top 10, seed investor list or this or that, right? And because like the companies of the boards he sat on, although they were consensus investments and then those I've helped, are like really impressive. And I think if we turned over data actually on like, which board Satya was on, like he would have been at the top of that list. And so, I think we don't do attribution. We believe the partnership is a, success because we care about each other first and foremost. But I also don't think that like lack of attribution, should lead to anonymity, should lead to like, lack of congratulations. And like, I feel great that Homebrew has succeeded. And often that's because of my partner, attribution or no attribution.
Oh,
I don't want to say anything more. We can just end it right there. That's perfect.
I would just mic drop it, leave it.
Right.
That's so sweet. Well, I mean, I spoke to one of the kind of solo GPs, early innovators in the kind of the fund GP on their own, Jason Lamkin, a mutual friend of ours. And on the theme of sweet, there's also a flip side. It's sometimes tough, like marriage. It's not always easy. I'm not married, so I have no idea. But what were the toughest moments as long-term partners when you actually think back? Are there some that really stand out?
We've both been married for a long time, so to one another and to spouses.
I mean, honestly, like we've had such a smooth partnership. The hardest part of our partnership was the decision to get going. Once we made that decision, because we spent all that time laying the foundation, there haven't been major arguments. I think the only things that we can think of that would be, arguments are when one of us is on the board of a company and is pushing really hard to take more of a hard line with a founder or a co-investor, and the other person is saying, hey, reining in a little bit.
Or vice versa.
Those are more...
Like from outside the org chart, I'm like, what the fuck? Harry, have you, basketball, are you a basketball fan? You like,
oh,
so,
yeah.
Sometimes like when a little scuffle breaks out of the court between two teams, like there's, one guy on the same team trying to hold his teammate back. And that teammate is like, get the fuck off me. I want to punch this guy. I think that we have those sometimes. Like we're never the two people on opposite teams scuffling, but like sometimes Satya has to hold me back when I'm like, are you kidding? I have 280,000 Twitter followers and no LPs. I'm going to call this bullshit out. And he's like, like, why is that helpful? Or vice versa. And so I think the reason our partnership doesn't have that conflict is not because we started in such a charmed place that like there's never a speed bump. It's because we commit to the relationship, to re-examining it, to understanding each other. We used to do every other year like an externally led 360-degree feedback real process with our founders and some of our co-investors. Not, like a survey, or an NPS score, but like talking 30 minutes to each of our founders and some of our co-investors about Homebrew, about each of us, and like getting that data back, trying to become the best version of ourselves. Like I do therapy, like that's great for me too. And so, we try not to just have a notion of, what Hunter and Satya were in 2003 working at Google, or what Hunter and Satya were in 2013 when they started Homebrew, but like what Hunter and Satya are in 2023 and how we meet each other. I'll tell you a quick anecdote. When we got our first, sort of, what do you call it, like term sheet, from our LPs, like very standard, like I said, institutional LPs. So it's like nothing was weird, one way or the other. And some of the things we negotiated hard on were, LPAC like voting or votes that would have to do with our ability to run our firm, right? So we got rid of, things that would like, have any degree of micromanagement or approvals or so on and so forth. But the thing we didn't negotiate on was the notion that if one of us left the firm, that we had to have like some very high, LP, voting threshold in order to continue Homebrew. Because we wanted like that dead man trigger. We sort of wanted this notion that Homebrew is the two of us. And if it ever ceased to be the two of us, like there should be a real cost to that. There should be a real deliberate decision, not some capricious thing of like, well, I got a better offer to do this, or you want to do that, or we're not getting along, or I want to work in the office and you want to work from home, like, silly little things. And so I just sort of feel like we've embraced this notion that like the two of us, are Homebrew, and like Homebrew will grow and evolve. And I'm sure we're going to talk about that evolution. But that like, it's a commitment to the two of us ahead of it is anything else. We also started with the idea of no succession plan, no growth. Like we started in a space where we had a lot of the same vision for what we were building. And I think a lot of those tensions are often what cause conflict, either because they weren't discussed early enough or because there's disagreement from the get-go and you figure, success will solve all things, and that's not true.
The other thing I'd say we're cognizant of is that, people and circumstances change. And so much like a marriage, like we invest in making sure that the relationship remains healthy. We do a quarterly offsite with just the two of us every quarter. And a part of that conversation is, how happy are you? Right? Like along a bunch of different dimensions.
Actually, can I just interrupt you and ask you, how long is that offsite? Do you set an agenda for it? Do you put a plan in place for it? I would love to understand so I can implement this.
Yeah, our next one on Monday.
We do have an agenda. Yeah, we do have an agenda for it. There's no fixed time. We set aside most of a day, and sometimes it's 2 hours, depending on the agenda and how things are going and what we want to talk about, and sometimes it rolls over into dinner. So it really depends, but I think we're committed to making sure we have that conversation and talking about whatever is important to talk about during that quarter, both looking backwards and looking forwards.
Before we kind of discuss kind of looking forwards in the next generation of Homebrew, I do have to ask you, a lot of partnerships I think break down because of financials actually, carry structures, salary structures. How important is equal salary and carry in a partnership like this?
I think the thing that we're really proud of is every decision we've made has been consistent with the idea that it is a partnership that is oriented around the two of us being mutually successful and mutually happy. When you think about things that way, decisions around economics are easy. We've been to equal partnership from day one and have never changed that and never will, even as we're investing our own money. We have never done deal attribution, as we talked about. So all those kind of tactical decisions end up being really easy when you're committed to the idea that Homebrew is the two of us and two of us in equal partnership.
Look, Satya, I think that's all true. And, furthermore, we've built a structure where we're both comfortable playing, like being long-term greedy, like playing the long game of, hey, everything we're doing here is based on the notion that we're good at this. If we're good at this, we're going to make money. If we're not, like, who cares? I don't want to spend 20 years not being good at something. I think like, not that this is, sort of unspoken, because I think we've both talked about this, but like, we also started this later in our careers, right? Like we were both in our, mid-late 30s. And I think it's like, we were both above a financial, threshold. Like, it's like this, Americans hate talking about money. Like it sounds so uncouth, but like, look, like we both had made millions of dollars, right? Like, and saved that, right? And so the idea that, and lived below our means, right? And so we didn't have to build towards well, look, I made this much last year. I need to make 2x this because I've got 3 wives and 4 mortgages. Like we were able to make some deferrals on, optimizing for short-term economics because of our, individual and collective successes. And we were starting at the same place in our lives with the same types of material goals, which was like, we don't have to maximize for dollars. We want to maximize for spending time together. We want to maximize for the people we work with. And we think we have a model that if we do that well, everybody's also going to make a lot of money.
You spoke there about kind of the financials and the personal financials, which we all kind of like shy away from. I mean, we're incredibly British of all of us. But how should founders and VCs then talk about personal money, do you think, to each other?
Well, I think not surprisingly, when we were, executing for that first decade, our, sort of seed lead investor model, like talking to founder, we were for the first or second largest, shareholder for those first 3 to 5 years most of the time. And we had like lots of conversations with founders about wanting to make sure that they were in a situation that they could focus fully on the business. Sometimes that meant salary bumps. Sometimes that meant a little bit of early secondary. It didn't mean winning ahead of the business. It didn't mean taking advantage of hot markets to cash out ahead of your team or investors. But it did mean like going, if you just raised, a $20 million A round, but yet you're still living in a 3-bedroom apartment because you're, student loan heavy, cash poor. Well, let's figure out how to solve that problem for you so you can like move into a place that you can actually work out of, without worrying about whether your roommate is drunk, and focus on your business. And like creating space to see, Satya talked about seeing each other as people and how important that was to our partnership. I mean, I think that's the same thing when it comes to founders, trying to see them as people and understand that like, if you're going to bat with this, long-standing notion of like, hey, we all win at exit and, nobody should talk about economics ahead of that, like the very least you're missing opportunities to de-stress founders in a way that will increase the probability of a wonderful outcome. And at the worst, you're exploiting, founders who have all their eggs in one basket, while you're sitting on this, portfolio and fee structure and, preaching ramen profitable, from the Yellowstone Club.
And that's the key is like startups are hard enough, right? Like if part of our job is to like help reduce the stress for a founder. And so if we can have the conversation around like, what's the minimum you need to make so you don't have to worry about your personal life? Like that's a conversation that we should be having, at the beginning, but then throughout, because life circumstances also change. And so to Hunter's point, there's lots of conversations in today's world about secondary liquidity for founders. And I think we're of the opinion, like there's no hard and fast rules around this. Like obscene amounts of liquidity is obscene, but small amounts of liquidity can really free up a founder to do their best work. And sometimes that might be at the Series A, and sometimes it might be at the Series D. But you've got to be really thoughtful and be willing to engage in the conversation with the founder to determine what's needed. And the founder has to be practical about what's realistic and what makes sense at a moment in time.
Well, I mean, speaking of money, the truth is that so much of our industry is predicated on fees. And you guys decide, no, I'm not going to do this fee gathering. I'm not going to make $20 million a year on fees like some of our wonderful friends at multi-stage funds. A wonderful decision in many cases, by the way. I just want to understand that, because when I saw this, I was like, holy shit. Like, wow, that's amazing. So take me to this decision. Whose idea was it to do your own money and say, thank you, LPs, but, we're going to do our own money from here? Whose idea was it, and how did that discussion go down, guys?
I'm going to let Satya describe it because he does things much more succinctly than I do, but I think what it's important to point out is that, like, fee minimization wasn't the goal. Like, right? Like, there's nothing wrong with fees. The question was, do you maximize, is it something you're seeking to maximize for, and thus that makes a bunch of other decisions? Or are you building a model that you think is at sort of the intersection of success and happiness and can live with some of the implications for what that means short term?
Fees were never part of the conversation, right? Like when Hunter and I started Homebrew, again, we kind of talked about our long-term vision, and we always had this notion in our minds that maybe after 20 years, we could become a family office and do things on our own. And the good fortune of the last decade and kind of our view of where the market was headed led us to decide to do that sooner. And really, it was just a strategic decision. Our view was and continues to be that in today's market, at the seed stage in particular, $100 million fund is a bit of a tweener. You've either got to be larger to be able to write large checks and get the ownership that you need in order to win the best opportunities and deliver the types of returns that LPs expect, or you've got to be smaller and give yourself flexibility in terms of check size and ownership, but have a small enough fund that doesn't require you to optimize all of those things with every single investment. And so we decided that getting larger was an option, and our LPs were going to be supportive of that. But it required breaking from what Hunter and I had said at the beginning, which was this is going to be a 2-person partnership. It's going to be that way forever. And we don't want to build a firm and infrastructure and a services platform and all those kinds of things, which having $300 or $400 million in a fund would require. It also puts you in a box from a strategy standpoint, because the larger your fund gets, the more disciplined you have to be about check size and ownership and stage and all those kinds of things. And so we weren't interested in getting bigger from that strategic standpoint. And, economics of management fees were never part of the conversation. Once we decided that smaller was the better option for us, then it became a question of, well, if it's smaller, isn't the ultimate flexibility to be investing our own money rather than third-party capital, and being able to experiment with different ways of investing, and doing that in a way that we feel is responsible, which means not playing with other people's money while we run a bunch of experiments, but playing with our own.
Okay, question for you. So you decide that, and then you have the next question of like resource allocation. Do you then say, okay, we're going to put 25 million, say I'm just taking like, 20%, 25% carry, same in terms of like the invested capital that will go back to you. Do you say 20 million of your own money and say, great, this is our budget and that's the same as a $100 million fund? How did you do resource allocation on the initial budget?
Yeah. So here's the way that we thought of it. Like Satya said, we sort of had this notion. The choice that we made last year was something that we sort of had in this glass case that originally was going to say like break glass in 2030, right? Like, so we had thought about this, and all we really did was break glass, 8 years earlier. We'll see if it was premature or not. And as Satya talked about a little bit, one of the reasons for doing that was trying to think about what, fund size and did we want to get bigger, which was always a non-goal. When we then did sort of the bottoms up question of like, well, okay, how do we budget for this? We sort of decided that, nominally, let's assume the same investment cadence, 10 to 12 investments a year. Whereas before, maybe we had an ownership goal of 10 to 15% and thus an average check size of, $1.5 million or whatever, and held reserves that, we wouldn't necessarily have an ownership target. We wouldn't necessarily hold reserves. Where do we think we fit in nicely on a cap table, at a seed A or B that we want to work at? Well, let's just nominally say that, our check size is going to be between 100K and 500K. And indeed, in 10 of the 11 investments we made in 2022, it was within that range. And so let's do the math. What's 10 to 12 investments a year times 100 to 500K, no reserve model, and let's budget that for the first 2 years. So let's think about how much we want to take from our savings that allows us, combined to, make 20 to 24 investments over a period of 24 months that are likely to be between 100K and 500K. And to be honest, look, this is all rarefied air. So when I say to be honest, it's quote unquote, that's not that much money. Obviously, it's a luxury to be able to do it, a privilege to be able to do it. But when we sort of told some people this, they assumed that like we were billionaires putting aside $100 million, to invest in startups. And like, that's not the case. Like, the idea and hope is that by year 3 of this model, we're not pulling from savings. We are taking carry from, the continued carry from years 1 through 10, Homebrew 1 through 3, and that is funding years 3 through 7 of Homebrew Forever. And by year 8, that magical 2030, that originally was when we were going to start this, hopefully we're recycling proceeds from, 2022, 2023, right? So if you look at it and say, what sort of capital do you need to get started in this model? It's not replacing the next decade of otherwise institutionally led, funds and 9 figures of capital. It was basically like, are we risk-seeking enough to take 2 years worth of investment capital from our bank accounts and put it back into the market? And we looked at each other and we said, yes. So let's do it.
Can I ask you said they're about 100 to 500. Does that not put you in a little bit of an uncomfortable position because you're not leading rounds and you're not an angel? And so say we have now, as we often do, many of the multi-stage funds come earlier, and I'm just doing a hypothetical scenario here. It's a 3 million seed round. Excel want to do 2.4, 2.5 of the 3 million seed round, and then they've saved the rest for angels. They're not going to let you come in and take 500K or even 400K and replace all of the angels. And because you're not leading, you don't have ball control of the round. So does it not put you in an uncomfortable...
Oh, Harry, you're thinking like such a fund manager because I said 100 to 500K and you're immediately thinking that means we go and want to take the 500K. We're happy to take the 100K, 150K, 200K. I think in 10 of the 11 investments that we made last year, we were offered more allocation than we took because what we care about is really sort of working with great founders and great co-investors. And with a large fund standpoint, actually it's flipped. Larger funds who before really could only work with us when they were following on the seed companies that we had led, now are actually quite excited to, get us involved earlier because, the idea of getting our help, stewardship, collaboration, and not having to place 10 to 15% of the company with us, only having to place 1% of the company with us is a boon. The place that we've seen actually decrease deal flow are from other seed stage funds writing similar sized checks to us now. Because before, those folks and the people who we are close with, this is a safe space, Harry, right? We can name names. Like, we work just as much with Founder Collective and Box Group and these folks who, we've always been very close with. But some of the people who we also like, but, who would approach us on almost any deal that they were doing, we fell off their radar because their goal is to place a lead, right? If they place a lead, the round gets done and they protect their allocation. And there's a bunch of 100 to 500K people wanting to get into these deals who need to find a lead. So we've seen a dramatic increase in deal flow from the multi-stage funds and from some of our former, competitor friends who we would just always joke like, we're never going to invest together because we both want 10 to 50%. And we've seen a decrease in deal flow from, sort of people who are writing similar sized checks, not because
Hunter,
they think we're competitive.
Can you put your arms down? Sorry, it's rubbing against your
Oh, sorry. I'm posing. I'm flexing. I'm flexing verbally and physically on you, Harry. But if we've seen sort of decreased deal flow anywhere, it's actually in sort of the things we look more similar to now. And I don't think it's competitive. Like, I don't know. I don't feel competitive, but I think it's just more pragmatic. It's like they have a goal to get to find leads. And what's funny for us is it's flipped a little bit because we can still be first person to commit to a round and we can form an institutional round, around us in a second, right? So like, we still have the relationships and credibility that if you're trying to raise $4 million and we only want to do 250, given our new model, we can find you that other, 3.75 million, within a week.
It's important. The flexibility that we have in not having a fund now is that we don't have to think of every investment as having the potential to return the fund, right? Every investment just has to be a good return. And that means that if a founder wants to work with us and we want to work with that founder, we can fit into the cap table in whatever way makes sense, given the construct of that round. All of that said, like, we're also big believers that you're a buyer or you're a seller. So when we want to buy as much as makes sense and is available to us. And so, we can be greedy, but we're only greedy when the founder and the other investors want us to be.
He's cleaning up my statement saying that we've taken less than offered because he wants to be able to take it all in the future. The one thing that, now I'll clean up his statement just to say, it's important that the way that we're thinking about outcomes is still venture scale, right? So it's not like, oh, well, hey, because this is all our money, instead of needing a 20x, to get, 5x net, 4x net into our pocket, we can just hit a bunch of 3x and 4x's and that'll be wonderful. I don't think there's such a thing as like de-risked seed. Like, you should be betting on companies that in a success scenario can be wildly successful and worth a incredible amount of capital and want to own a percentage of those. So to your questions around like deal selection, I think we've maintained the same bar. We've probably narrowed the top of funnel a little bit. Before, you could imagine that when you're thinking about a portfolio, 30 companies, a fund, that's some things that you're kind of like not that interested in, but come to you via a trusted source and like pattern match founders. You're like, well, I'm not passionate about this, but we should at least take a meeting, right? Because I could see, low code, and look, this is great businesses. They're just not things we're as into. Like low code, marketing automation for enterprise CMOs, like, started by an ex whatever person. You'd be like, oh, I could see that as part of a portfolio, and that's likely to raise an A, so on and so forth. Now, if you look at each other, you're like, are we familiar with this market? Are we passionate about it? And we're excited by the founders and co-investors. If like all of those don't check off, like let somebody else do the deal. Like we don't need to construct a, portfolio anymore. We just want to invest in people that we want to get up every day with and, go to work on behalf of.
Sorry, this is like, landing on Mars. I'm 3,000 shows in with, VCs and, inherent.
Harry, when we told our LPs that we were thinking about this model, they said two things. One, this is very consistent with what you've told us, despite our disappointment. And two, you have to give me a few minutes to think about this and decide what questions I'm going to ask you. Because the questions that I usually, what fund managers usually tell me, this was, 2021, was like, I'm used to everybody coming back and saying, we want to get bigger and invest faster. And I have my set of questions to say, why do you think that's a good idea? Like, are you really sort of getting too big for your strategy? Like, is that the right model for outsized returns? What's your capacity? Like, when you say we want to get smaller and maybe not use your capital, like, I don't have a standard set of questions to ask you as an LP.
It's not even like a founder collective. Like, we're staying disciplined. It's like, we just don't need it at all. I think it's just like, what? But I'm just like, I'm confused. So do you become less price sensitive with this shift?
Yeah, so we become what I think is we become price agnostic as it comes and terms agnostic when you think about how much do we own, right? Like we're not doing that math. We don't change our model, our discipline, our thinking on the question about the way this company is being financed. Is that a help or a hindrance to its ability to get a future financing done, to create upside for shareholders, so on and so forth, right? So it's still it's both in absolute terms and then in opportunity cost terms, where are we going to invest? It's not that, oh yeah, hey, we do uncapped notes or we do seeds at, 100 million pre or whatever, because who cares? It's our money, not somebody else's. We care a lot about, we care more in these cases about who the lead investor is in the rounds we're joining, because it's not us, right? We used to not care who the other investors were. We're like, we're going to help you and we'll get other people great around us. Now we actually care about quality, of the lead investor. We care about whether somebody is pricing themselves to perfection. We care about whether they're adding new pockets around the table versus just drawing down the last check, from investors already on the cap table. And then we write the check. So yes, we are less price sensitive in a computational manner, but not less price sensitive in a strategic one.
I have to ask, everyone feels the pressure to deploy when you have institutional money. I speak to many friends at, multi-stage funds, and they're like, fuck, Harry, with these big-ass funds, how are we going to spend them this year? There's no flow. I've got nothing now, Harry. Do you have anything? I'm like, I got nothing. And everyone feels the pressure to deploy. Did you feel the pressure to deploy, honestly, when you had Homebrew? And, is that very different now?
I never felt like we felt the pressure to deploy. But I feel like one of the reasons we made the switch early was we were questioning the looking forward strategy of raising a large fund, a potentially even larger fund, without confidence that that we wanted to execute the same strategy for the next 3, 5, 7, 10 years, right? So it was going to be tail wagging the dog a little bit. We knew we could be successful doing it. We didn't know if we could be happy doing it. I think that's important to point out. It wasn't so much that like raising $200, $300 million, like some of our peers, and going to market in a model where we brought on another GP, we expanded our team, we brought on another platform person. Like, I actually think we could, exceed our benchmarks and be perfectly fine in market. I think it would have forced more and more time and energy and choices that would have sacrificed happiness for success. We would have spent more time on internal operations, hiring and managing a team, rather than with one another and with founders. We would have, I think, whether people want to admit it or not, I think people attribute this to Mike Maple's affiliate, and it's 100% true. Like, your fund size is your strategy, right? And so whether it's implicit or explicitly, you start looking through this question of, well, I got to return the fund. I do the math. What does an outcome look like? It means you start increasing your ownership target to the point of where you can no longer be collaborative, and or you grow impatient, or you're looking for the next write-up rather than patience on how do we build this company and help it become the best version of what it's going to be. And I think if those are your true norths, if you're like, if we do all those things well, we are going to have companies that we're so proud to be associated with and make a lot of money, then you do a different type of math on what a quote unquote fund model looks like than if you just you look at the market around you and say, how much does it take to lead a seed round? How many of those deals are we going to do? What sort of reserve structure? Okay, we need $300 million. And let me tell you, LPs, it's not just fund managers are greedy. Like, LPs are complicit in this. Like, we love our LPs. We've always had a small group of institutional LPs. And we used to joke with them, like, after, especially when the first fund started to become a really high performer, and we sort of held to our model in fund 2, and everybody was congratulating us for like being so disciplined. Like, when we'd go to fundraise, they'd want to double their, super pro rata in the next fund. I'd be like, well, you just complimented us on being disciplined. how do we give you double pro rata and stay disciplined? Like, there is a pile on to what works mentality that sometimes then you get what you didn't want, which was like too big a fund to deliver the types of returns matched against the capabilities and preferences of the GPs and the market stage and strategy they're executing in.
I'm just going to come back and answer your question here. Like we never felt pressured to
what are we
deploy
talking
capital.
about? Who is this?
We never felt pressure to deploy capital, I think, for two reasons. One is that we had institutional LPs who have a very long-term commitment and perspective on the space. And so they didn't expect, and because they're institutions, we're actually a pretty small fund for them. And so whether we invest, over 2 years or 5 years makes actually no difference to them.
Nobody cares about IRR.
The second thing was that we're big believers in time diversity. Like even in the market over the last decade where everyone was putting their funds to work in 18 to 24 months, our funds were being put to work in 3 to 3.5 years.
Yeah.
And so,
Satya, what's the number one predictor of returns for a fund? You always said the vintage.
Yeah, the vintage.
I think vintage diversification you'll really see the benefits of in this next cycle. I look at mine now and it's like I'll have some 2021 pricing in there, but I'll also have 23, 24 pricing in there. And I think that's really where you see it, because vintage diversification didn't matter over the last 10 years because the vintage was all ridiculous. Right. Do you know what I mean?
Yep.
Satya, there's one. This is adjacent to what he's saying, but I'd say the one place we did feel like quote unquote pressure to deploy was the notion of if you're a lead seed investor, and an institutional A round's getting done, it's that pro rata question, right? Like it's always dancing around this like we have to be supportive, right? And especially during a bull market, there's a lot of deals that get done at prices that are higher and maybe rounds that are premature, that you sort of decide in a nuanced way whether like we've got the tiger by the tail. Well, tiger by the tail, that's probably a bad metaphor right now. We've got something here that's doing really well, and so sees it also. So let's pile on into it versus like, gee, I'd love to see more cards turned over before we, put $3 million from a, $65 million fund into it, to all the way at, in a up market. It's not just that rounds are bigger and higher price. It's that some rounds get done that wouldn't get done, right? Because everybody has a rosy picture of what could happen. And you're like, wow, some of the companies that, maybe we have questions about are still raising healthy rounds, and I'm sure how you're very nuanced as well. You do those, and what you do, and when you talk to the entrepreneurs in that case, you say, look, we probably own as much of this as we want. We're going to be supportive, but I'm sure there'll be a surplus of, interest. And if you could squeeze us down, like that would be preferable. But, part of the reputation effect is if somebody wants to lead the next round and we're like, hey, we're doing zero of our pro rata, like that has the challenge to scuttle around in sort of a lead institutional seed model. And like that was, I'd say we felt that pressure sometimes in a nuanced way.
What was so amazing about the boom of the last few years was bluntly, if you said you're not going to do it, they were like, great, we've got more. And so it was just so much capital that you could very easily say, I'm not doing it, and no one would give a shit. My question to you is, does your reserves thinking ratio deployment change in a world where you are deploying your own money?
Oh, this is what we're debating right now.
Well, live conversation.
TBD. I mean, the good news is, like, again, like there's not a fixed fund size. There's not necessarily an expectation that we're leading the round and hence are a signal in the market. And so I think it's going to depend on the situation. We're effectively the co-lead in a couple of investments that we've done. We're smaller checks in a lot of the investments that we've done. So it's going to depend, but again, like we don't have to think of it as a fund and a fixed pool of capital. So that gives us a lot of flexibility in terms of how we approach it.
Yeah, specifically, like, look, what we're trying to figure out is don't worry, like structurally, don't worry about pro ratas, right? Like, who cares? It's just a money opportunity. Like, it's not about, doesn't change the nature of how we work with these companies, so on and so forth. We made our initial investment. Sometimes we'll do pro rata, sometimes we won't, so on and so forth. They're quote unquote small checks anyway, off a modest first investment. Or, heck, like that's how you get paid for your work, right? Like we already probably work harder than our ownership percentage, relative to the value we bring to a company we back. Pro rata is how you sort of quote unquote double down on the winners. And we need a structure to accommodate that, especially when it, does or doesn't, fall within our budget. Or, hey, one of our opportunities is like, we've got access to the capital markets. And so why not do a barbell strategy where like it's our money at the beginning, and then, in select opportunities, we back up the truck, so to speak, and put, 7 and 8 figures of, blended our capital and other people's capital into the companies that we think, could use it at the, B, C, and D level.
One of the experiments we're running here is kind of the testing the thinking around, can capital and counsel be separated over the course of time, right? And so one of the things we're trying to evaluate is, in some cases, when we do a smaller check, can we still have the influence and add the value that a lead investor might have in a situation, and earn the right not just to do pro rata, but potentially do super pro rata or even lead the next financing, right? And so that's an experiment that we're running.
And do we want to? Like,
no, I mean, listen.
Oh, that sounds so complicated. Yeah. I'm thinking more, it's just like
us spending our time
when we can. It's our time. It's our time, and whatever we bring to bear, normally, which can be incentivized, non-incentivized, direct on the cap table, indirect through us, whatever. But it's just the notion of, then we have access to $5 to $50 million checks, when we want to deploy them, and are those SPVs or is that from another pooled vehicle? I don't know. We're very cautious. We want to be in business, even though it doesn't sound like it. We want to be in business with our LPs in some way because we actually really enjoy working with them. We're in business with them, to the tune of several $100 million, in Homebrew funds 1 through 3. We're in business with many of them through Screen Door Partners, a fund of funds that we helped start with some of our peers and your friends, Charles Hudson, Kirsten Green, Aileen Lee, so on and so forth, that backs emerging managers from underrepresented segments. That the first vehicle there is in, what is it, like a $90 million, $85 million fund. We've deployed half of it. We backed 11. So we have LP relationships that transcend Homebrew. And so like maybe there's, continued interesting ways to bring capital to bear when we think the opportunity and the relationship deserves it, rather than pre-raising the capital and then saying, we're going to figure out where to put it.
As an example, I think we've done a handful of SPVs now, but we did 2 last year, which led the Series E and Series D rounds for 2 of our later stage companies, by virtue of having built that relationship and taking advantage of the market dislocation where we just thought there was a better opportunity than the market recognized. And so,
Harry, we have one of our favorite companies is in 2 of our core funds, 1 of our overage funds, and an SPV. Like, it sort of reminds me of when you bet a number, straight up, and then the 2 and 4s on roulette, and it hits, and you're like, the stack of chips that comes back to you is larger than you understood because you're in it 3-4 different ways. So we are unafraid when we see something that we think is spectacular to figure out how to support them, through multiple vehicles. We just, believe that comes from a relationship and mutual trust and confidence that you're going to make money together. It doesn't come from pre-raising it, believing that all things go up into this, up into the right, that, mid to late stage SPVs are risk-free. And by the way, when we do an SPV, at least historically, I guess, subject to change, we've historically priced them very attractively because the idea is like, we want to make money with our friends and we're already doing this work anyway. So why should we get paid, sort of optimal, carry and fees like for just placing a check into a company we're in business with anyway. So like, we've been very, very relationship focused, long-term greedy. And I think that works when you believe you're good at what you do, as opposed to, needing to get paid first.
Over the last decade, there's like some fundamental things about this business that people have forgotten. First is like it's a relationship-driven business. It's not a transactional business. And being long-term greedy and good long-term partners makes a difference in your performance over time. And the second, I think, is that it pays to be non-consensus and right. Everyone was focused on being part of every company that seemed like it had momentum because everybody else was investing in it. And that looked great because the bull market ran longer than it did. But in markets that change, like that's not a strategy that's going to generate outsized returns. It's
Harry, I'm sure we're LPs, and I'm sure Harry and I are LPs in some of the same funds. That right now, when you see some of these helium unicorns deflate, we get the same 4 notes from the same 4 funds through the AngelList, whatever rolling funds, all writing down their exposure at the same time, because there's a bunch of strategies of like, we share deal flow, we pile into the same deals, and then we show it to the same, leads to mark it up. And it feels great, when, everything is and then,
Do you know what?
it doesn't always work.
Because that would make me happy. What I'm seeing is that no one's marking their books down and they're keeping them all at the incredibly inflated prices and claiming that that's still how it is. You don't have to change your markdowns. Like now, you just mark down to yourself, I take it.
Well, look, I'll tell you what, like, it's a struggle even on the old stuff, because like we think there's 3 sets of books, right? There's kind of your accounting docs, like how are you reporting this stuff, to your LPs, so on and so forth. There's your, sort of sensitivity model, like, for reserves and so on and so forth, like, is there upside here? And then there's what have you actually, returned, right? Like, are you, how real or not real are these numbers, right? Like, and so in the former, we've always sort of said like, we don't mark things up or down unless there's like a new financing or a radical change in a particular company's trajectory that deserves it. But we get pressure, not from our LPs, but from our auditors to be like, well, the public markets are like, all these numbers are arbitrary. Like, if I could tell you perfectly what any of these companies are worth today, like, I'd do that as a business, right? And so our strategy, and our LPs are fine with it, over the last year or so has been, from a reporting standpoint, use financings to mark up or down. From a sensitivity analysis, like, yeah, some of these things are probably quote unquote have to grow into their valuation, so on and so forth. So let's talk about what the fund looks like if, these were worth 20% less, 50% less, so on and so forth. Then how does that influence our buying or selling behavior? And then let's manage over time, which I think we did very successfully in Fund 1. We still have quite a bit of upside, but we managed to take, sort of money off the table at opportune times, both through early exits and M&A, which we're lucky, and then some, sort of secondary transactions, to be well above the, benchmark returns for 2013 to 2015 vintage funds, not in
grow into their valuations, Hunter. Come on, give me a break.
Nobody cares. Nobody really.
Everybody else's portfolio. Everybody else's portfolio is a bunch of zombies. My companies just have to grow into their valuations.
500k ARR, and it was valued at 700 million, and I was like, wow, 1,000x.
It just needs to get to 100 million ARR.
Easy. You mentioned there about kind of actually returning cash to investors. I can't remember who said this to me, but they said you have to ask them because they've returned a lot of cash. How do you think about when's the right time to sell in those secondary transactions that you did? Not when it's like M&A where you obviously have to. How do you advise managers, and how do you think about when's the right time to sell?
Oh, I wanted Satya, tell them about recycling too, because we've only returned cash when we think that there's a reason to return it and not recycle it. And thus we're at like, what are we at? Like 117% in Fund 1 now?
120% now.
Yeah, 120%. So we also, we do a lot of portfolio management, let's say.
The short answer to your question, Harry, is like, ultimately, I think we're always asking the question, are we a buyer or a seller at this moment in time? And you're a buyer if you believe that the risk-adjusted return is going to exceed your expectation for the return at that time, and you're a seller if it's the opposite. And so we've always tried to evaluate, like, as an example, with a fund and a follow-on investment, do we believe we can earn at least 5 to 10x from here? And if we believe that, then we're more likely to be a buyer. And if we don't, then, we're more likely to be a seller. And then the other factor is have you actually returned any money for your LPs? And when you haven't, there's a lot of pressure to do that. And there's a lot of freedom that comes from doing that as well, because once you get into the carry, we're humans, and your behavior will change in terms of how you think about investing. And so I think those are the two factors. And we'd encourage, all investors to ask that question. Like, do we think, if we're being honest about it, that there's upside, or does it just feel good to be part of this company because we caught it early and we may be giving up the potential of, some marginal upside, right? Like, we're big believers in regret minimization. And I think most investors don't realize, like, they're not going to regret the upside if they put money in their pocket, but if they don't take the upside and things go away, they're going to have a lot of regret.
Yeah, Harry, I don't know if you're, in the show notes, you'll put a little bit of background, but like, Homebrew was my first institutional venture experience. Satya did institutional venture like 98 to 2000, and then again like 2007 to like 2011, right?
Yeah.
And so he's seen different business cycles, different partnership structures, in a way that I think, we don't look backwards and say, well, overlearn those lessons here or there, or the markets now are the same as they were in the 90s. But like, I think of our value proposition as a partnership to Satya's smart enough and pragmatic enough and experienced enough to prevent Hunter from doing the stupid shit. And, sometimes Hunter's stupid ideas are actually good ideas. And so like the combination of that, I think, led to, a bunch of good debate, but ultimately like good decision-making and good frameworks for, when do we sell? And that was, I think it can sometimes come down to also this question of like, if it doubles from here, are we going to be sad that we took 5% off the table, or are we going to be excited that the 95%, has now doubled? And like, that's another type of question we ask ourselves. And, always in situations that, were neutral to positive for the company, because we never wanted to sort of hurt a company, through our actions. We had some good chances to do our job, and we did our job.
Is there a misalignment between GP and LP when it comes to liquidity and selling? And what I mean by that is, I'm an early stage manager. Shit, I want to raise my new fund. It'll help if I have DPI. I'm going to sell a couple of positions to provide DPI. But actually, for my LP, it would have been much better if I held on to those positions in amazing companies, and in the long term would have provided a lot more returns to them. But I needed my new fund.
Yeah, I think it depends on, one, the quality of your LPs, and two, there's a difference between your existing LPs and new LPs. I think if you've got the right LPs, they've seen enough in this business to understand that generating DPI through pressure isn't the best long-term outcome for them and for the GPs. And then existing LPs have more data to evaluate progress and understand the companies than outside LPs do. So outside LPs may care more about seeing DPI because that's proof. But the right inside LPs have more context to be able to make a more informed decision about how a GP is performing, and doesn't necessarily have to see that DPI. So the answer to your question is, I think there can be a disconnect, but there's a lot of variables that go into the degree of that disconnect.
Satya, what's the craziest idea Hunter's had that was actually a good idea?
I mean, it was kind of
getting the logo tattooed on my shoulder.
Yeah, there you go.
Hit me, Satya.
No, I mean, he does have the logo tattooed on his shoulder. I was going to say, like, in many ways, I give him credit for us deciding to start a fund. So, like, the crazy idea was to be a fund as opposed to doing something else. Because as he said, like, having worked in the venture business, wasn't considering doing it again. And he walked us through the thinking around, like, actually, the way we want to spend our time lines up really nicely with being helpful to companies. And we can be helpful to companies if we're venture capitalists, because the cost of entry is money, 10 years ago. So the crazy idea was to be VC, and I think I'd give him credit for that, and I wouldn't have done it with anybody else. And that's why we're fortunate to be where we are today.
That's not what he said to me in the prep call, Hunter. He said he'd much rather have worked with me, but I was too young. Anyway, I have to ask just quickly on the landscape today, and then I promise to do a quick fire. This is fucking terrifying for a generation of investors that haven't seen a downturn. How do you analyze where we're at today? Will this get worse? How do you predict the next 24 months playing for the early stage?
I think it'll get worse for Series A through D companies that can't remain, sort of like default investable. I thought, David Sachs wrote a very smart blog post last summer or last spring, at a point at which some of the common wisdom was like, for every company, make sure you have 3 years of cash and so forth. And like, I don't think those are uniformly smart recommendations to make for venture-backed companies that are relying upon a next financing. What you have to prove is that you have an insight and opportunity in a market that's large enough to where if you do your job, build your product, get to market, and exploit that opportunity, you're going to create enterprise value that's worth a new investor coming into your company. It's true that the dynamics around that equation have changed, reverted to the norm, maybe even a little bit pessimistic right now. But that means continuing to execute against a plan, smart growth, not growth at any cost, but smart growth. And I think we have too many companies that have been encumbered by capital ahead of product market fit and don't know how to find product market fit. Too many companies where their culture and their attitude. Let me finish, Harry. Too many companies that are encumbered by a culture and an employee base that doesn't know how to deal with, this is going to be tough and you're not going to get rich overnight. And too many investors who don't want to do the work, don't want to reconcile these companies because it would destroy their paper valuations, as opposed to let's reset them and give them a chance to succeed, take our lumps and see what we have, or let's have a tough conversation about this isn't going anywhere. You may have $50 million in the bank, but what are we going to do with it? And so I think for most of those companies, layoffs are going to turn into silent disappearance, low value acqui-hires, or noisy collapses. I think for new entrepreneurs, it's a great time to build companies. You just need to, sort of figure out that, what you're building, why, and the juice is worth the squeeze. And I actually think there's a number of companies that are, sort of in the public market, trajectory, that it's not a question so much about, are they going to be able to go public? It's they're waiting for an opportunity to make sure that they have not just the balance sheet and the P&L, but, a predictability so that once they are public, they don't get punished by the ups and downs, of potential underperformance. We have a few that I think could have been public, already, but have decided, for various reasons to hold off. And I think when they become public, they'll be even stronger companies.
Jason Lemkin said for employees join companies, unicorn companies in 2021 or 2022, they will make nothing from their equity. Do you agree?
I think that's definitely true for a lot of unicorn companies. But that's the difference between companies that raise money on momentum and hype and companies that raise money on fundamentals. Right? Like there are too many companies last year when the market turned who said, we just got to buy ourselves some time. And when the market comes back, we'll be able to raise money again. And what you're seeing is that time's run out, right? This is the year where they bought time last year they bought time by doing the layoffs and slowing down spend. And this year, they're realizing that the market's not coming back to what it was. And they actually have to demonstrate real business value. And those companies are not going to be able to attract capital, and they're going to go away. And that's, earlier stage companies and later stage companies. And then you've got that compounded by the fact that there's this VC overhang that everyone's talking about, but the reality is like everyone's got shit in their portfolios, so they're going to do their 1 or 2 investments a year, and every fund with this overhang is going to be focused on the same small set of companies. And so those companies are going to be able to, attract capital at prices that may seem like the market's turned around potentially, but the vast majority of companies are in for a world of hurt.
Yeah, if I was an employee, Harry, if I was an employee at one of those companies, the question I'd be asking isn't, it's sort of the decision tree is like, do I think this company is going to succeed or fail? Like, if you think this company is going to fail, regardless of stage, you need to make some decisions about, are you learning, so on and so forth. The question is if this company succeeds to some extent, am I going to participate in that success? Or is it being structured in a way where the investors and the founders are the only ones who are likely to see any of the gains? And if you're an employee who believes that, your hard work is not going to be recognized because of choices that your cap table and your founders have made, that's where, you should have some tough questions for your manager, for your founders, for your board, and make decisions not out of, sort of loyalty and hope, but out of pragmatism. Because I'm a big believer in teams should win when founders and investors win. It's the happiest moment in my existence as an investor when I see a promising company cross a threshold where I believe that it's going to change the lives for a lot of the team members, not just for us and the founders. And I'm hoping that one of the success metrics for Homebrew is the value created post-public exit, right? Like, I want us to be part of companies where it's not that we sold at exactly the right time and the retail investors lost and we won, or even that we've held on to the share, this now multi-stage public-private market crossover, like where we've held on to shares so long that we've exploited, all the gains. Like, I hope we're part of companies where like we got our bag and then that company grew 10x from there over the, 10, 20, 30, 40 years once it was public. Like, I want to die with, public company logos on my casket that, endured, weren't just, somebody else's goodwill write-off, and I got paid.
I also think, Harry, over the last decade, like we moved into a world where people joined startups because they thought they were going to get rich, right? And like, I think that what people should be thinking about is like, you join a startup because you enjoy the experience, you learn, you meet great people, you learn something, and that hopefully you get compensated fairly. But the idea that like getting rich was table stakes when joining a startup is something that I know we sound like grumpy old men, was a delusion because of the broader environment over the last 10 years.
Or maybe the scale, maybe it's not just the frequency, how easy it is, but also the scale. Like, what it means to, have access to millions of dollars, quickly versus like, oh man, my salary is $200K and I can make another $200K when this company, like for my stock, like, wow, how liberating is that in your 20s to be able to put that in the bank and then make decisions that, don't have to optimize for making your student loan payments or so on and so forth. Like, we're sort of, it's the byproduct of the bull market where you kind of have your perception reshaped by outliers, right? And it's not that those things aren't possible or not obtainable. It's just they're called outliers for a reason. It's like founders are like, well, I want the Jack Dorsey deal. I'm like, you don't go found Twitter and then you'll get the Square deal, type of thing.
I would tell those entitled people to start a podcast. It's much more lucrative. Final one, I promise. You said about like the entitled, young investors who maybe don't want to do the work. My problem is, and I'm being very open in a way that I shouldn't be, and I'll probably get killed for this. There's one company I'm in that's not very good, and it's got far too much money and no product market fit. And I said, hey, it's okay. Give the cash back. You've tried your best. 70 cents on the dollar. It's fine. You know what? Everyone goes home with their, respect and pride intact. It's okay. And I went to the other investors, more senior, more mature, and they all went, oh, Harry, no, it's a bad look. We don't want to get money back from founders. Oof. And it was just like, they all made a fuck ton. And it was kind of quiet quitting, and they don't want to look bad. And there was too much of a protection of their own NPS. So I'll push back on that and be like, hey, respectfully, for the people who are more senior GPs who have made a lot of money, they don't want to rock the boat. And I'm sitting here going, fuck, I don't have any support.
Yeah, not knowing the specific situation, but I generally fall in your camp, which is like, there's an opportunity cost to everybody's time and capital, and the idea that, some notion of an upside that doesn't exist, we have to raise our next fund, on this paper mark. So let's not speak truth to founders, or let's not let the founders off the hook, like, because, of our ego, our credibility, our reputation. I think those are, neither one of those is the job of an investor, right?
I'm going to take the other side of this, because my view would be like, VCs, we're in the business of losing money, right? Like, there's a reason that the power law is a thing. And if you still believe that the founders are smart enough to try to figure something out, even if it's a pivot, then you let it ride and you see if they can make it happen. If you think like it's a path to zero, and everyone agrees on that, then there's a different conversation. But I think
that's what I got the sense, though. That's what I got the sense Harry was intimating, that this isn't a question about, well, but we really believe, like, let's go back down to a small core team and try again, or we really believe this, and like they're still going to grow 2.5x, not 4x, but like, and it's not like I want that money back to redeploy. It's sort of like let's have a real conversation about what's going on here, and are we going to spend that $40 million to create a multiple of an enterprise value? Or are we just, kicking cans down the road because we don't want to ask these questions?
Yeah, and burning more and more money every day with something that we know is actually not going to work.
When you have a lot of capital, you end up trying to use money to solve problems that money shouldn't be solved for. Money doesn't buy you product market fit. Money doesn't solve for upside down economics, and money doesn't solve for not being able to hire, right? Like, yes, in the short term, it's like, sugar, you'll feel a burst of energy, but, it's not sustainable. And so for me, some of the biggest challenges we've had in the portfolio, just in terms of spending time and resetting them, have been the promising companies that got funded ahead of product market fit, or ahead of, sort of knowing what they would do with the capital. And even with patient investors, even with investors who, exert no pressure, it changes the mindset of the founders. It creates pressure from within the company. The clock starts. You start spending it. And so in some ways, I think part of our portfolio that's really going to benefit from the slowdown are the early product market fit, companies that now have some capital in the bank, but aren't getting the crossover investors pitching them on taking another round just because, it's available to them at great terms, and, don't have to have the notion of, well, if they don't raise an up round 12 months from now, they're not going to be on the unicorn lists, type of stuff. Like, I'm so happy to have a reset for those folks, because we can actually focus on product building and team building, not on fundraising, and hope that, the capital makes everything else work.
Final one, I promise. Does money make you happy? I would say that it's removed so much pressure and stress from your relationship that it's given you the foundations of a truly beautiful relationship, which is great. But, I've been in partnerships before where you both need cash, and it puts strain and pressure on every day. Does money make you happy?
For me, it's been a step function. I grew up downwardly mobile. I started out like 0 through 10, upper middle class, and then middle class from there. So I got to see what it was like to sort of be around things I wanted, but not be able to have them. And so the chance to, through my experience at Google and, what we've been able to do at Homebrew so far, my chance to get to a point of stability where I know I'll be okay. Like, I can pay for my daughter's school, I can, pay my mortgage, all that type of stuff. And, has relieved a lot of stress and allowed me to focus on what also makes me happy. There's probably a next bump up where, like, look, I'm the strange VC who only owns one house. Like, there's another bump up where, like, oh, hey, getting a pied-à-terre in New York would make me happy. That's where I'm from. Like, I'd love my daughter to have a set of keys there, that type of thing. And fortunately, I think we're on the path, like, to that. But
Hunter, Gulf Stream.
No, I wouldn't optimize. I wouldn't optimize for getting there. And once I get there, I'm not sure there's another step function that like is a goal that I'd shoot for. I've always sort of said, like, if I became really, really wealthy at any point, it would be sort of a byproduct of something else, not the objective.
I'm the child of immigrants who came here with nothing. And so I think money has afforded me the freedom to not have to worry about the basics and allow me to spend my time the way I want to spend my time, with the people I want to spend it with, and to give back in a way that allows hopefully people to have the same type of success and opportunity that I've been afforded. So
that's why we started Screen Door. We're both LPs in that as well. Harry, I'll say this though, look at any partnership where there's, difference in age or unequal distribution of economics, and money is an issue, right?
Yeah.
Like we have similar age and equal.
No comment. I'm not.
we have similar age and and similar goals and similar-ish economics, and so and similar values, right? Like that matters too.
I'd like to think that even if we had started Homebrew without some of the economic security we had, that if we had started it in a similar place and been aligned around how we wanted to think about money and the objectives around money, that we'd still end up in a similar place in terms of the dynamics of the partnership.
Probably, although such, I think if I were 20 to 35 and we had started this, hold aside my capabilities, without the operating experience, would I be any good at this? I think I would have my ego and my desire to find some degree of financial safety, security, that I, felt like I lacked, would have probably made me more likely to value growth, AUM, fees, that type of stuff, and try to build a model around that. I think we still would have had the sense of perspective of you can't take, you can't design your strategy on one hand and your financing on the other. But I think it would have been more important to me if we had started this earlier in a way that would or wouldn't have resulted in us doing it together, right? I'm not 100% certain it would have fit together in the exact same puzzle. So I think,
agree.
Frankly,
I think it's more likely we wouldn't have done it, but if we had done it, I would feel really good about what that dynamic would have been.
Yeah.
Satya, you're forgetting Hunter's SoftBank-sized ego. No, I'm joking.
No, look, it was really important to me. This sometimes served me well and sometimes didn't as an operator. I wanted people to believe I belonged in the room, and that I was smart, or that I had the respect of my peers, or I mattered, I was relevant. And in my 20s and early 30s, that was important. It's less so now in a way that I think benefits, sort of our partnership and benefits our model. But, that's a personal journey.
Guys, this has been such a joy. I'm going to do a quick fire round and we're going to bash through them, okay? So we're going to start. Hunter, why the fuck did you quit Twitter?
I was a blogger before I was a tweeter. And so I wanted to go back to more than 280 characters. HunterWalk.com.
Well, there we go. Salesman at heart. Satya, tell me, what are you most optimistic and hopeful for today?
I guess one's professional and one's personal. I'm most optimistic about on the professional side about the democratization of access to capital, including and expertise that allows startups to thrive, especially capital for, we've got a lot of work to do, but for underrepresented founders from underrepresented managers, which we're trying to contribute to. And on the personal side, I have a 17-year-old and a 14-year-old effectively. And I think that generation has an entirely different perspective on the world than the generation before it, and is willing to question everything from first principles, willing to do the work to see that the change that they want, and really care for other people on the planet. So I'm really optimistic about this next generation and the impact they're going to have on the world.
Hunter, what are you most worried about that you see in the world today?
I worry that some of the people most empowered to make positive change also have the wealth and comfort to protect themselves from the changes occurring. And so rather than risk something, disrupt their lives, to put themselves on the front lines of environment, equality, democracy, they protect themselves from being impacted by them.
Satya, what do you believe that many around you disbelieve?
In the context of our business, there's probably a couple things. One, at the earliest stages, when it comes to hiring, I think attitude is more important than aptitude. It's something that we really focus on when helping our companies hire early on. And then the second thing, which is probably odd for a former product person to say, I tend to believe that it's not the best product that wins, it's the best distribution that wins. Yes. And that the best distribution creates a feedback cycle that allows you to have the best product over time, but distribution wins over product in the early days.
Hunter, what's the best investment advice you've ever received?
It was from Satya, and it was during a pre-investment process where we were, maybe enamored by the idea or the social proof around it, but just not feeling great relationship with the founders. And he said, if it doesn't feel right before you write the check, it definitely doesn't get better after. And so we passed on it.
I love that. It's so true. I want this from each of you. But what does true success mean to you? Everyone has a different definition of success. What does success mean to you?
It touches on what I said before. Like, success is having the freedom to spend my time the way I want to spend it with the people that I want to spend it with, and leaving those people in the world a better place than in which I found it. And money affords some of that, but a lot of it is just work and effort as well.
Hunter?
Yeah, I mean, I think that the work I do, or the way I spend my time, I want to, grow the pie, I'd say, before I get my piece. And so for me, it's about making sure that the benefits I've had, access to people, ideas, knowledge, information, resources, that I'm, paying that forward in my work, with my family, and especially with people who are trying to, sort of access tech and the tech community. I was a history major. So I believe that, like, even though we're so focused on disruption, obviously, as technologists, that it's important to know the shoulders that you stand on. And that's, in fact, where the Homebrew name comes from, after the Homebrew Computer Club, PC enthusiasts who met on Stanford's campus in the 70s and 80s as hobbyists before they were, sort of entrepreneurs, and it's where Steve Jobs and Steve Wozniak met. And, although a lot has changed, including, the breadth and diversity of the people who get together to talk about this stuff, I think it's important to remember that, you should be interested in what you can create, ahead of, what that creation is worth.
Guys, I've absolutely loved this. This has been the highlight of my day, highlight of my week. Honestly, it shows like this which make me remember why I love what I do so much. So thank you both for being such rock stars today.
Well, we know that you, mostly have, just a single guest on. We appreciate that you let us have both, but I think given the nature of the discussion and 10 years into Homebrew, and, it only felt right to do it together.
Thanks for indulging our rambling and chaos.